Hello everyone, this is Japanese Economic Review Channel. Today, we will dissect the historic shift in Japan's monetary policy, analyzing the July 2026 monetary base statistics. The data reveals a dramatic transition from monetary expansion to a policy-driven, double-digit contraction. Our focus will be the mechanisms behind this contraction, specifically the aggressive drainage of institutional reserves and its profound implications for the broader Japanese financial system. Let's begin by examining the top-line figures. As of July 2026, Japan's monetary base has contracted by a staggering 13.8% year-over-year. This double-digit decline marks an unprecedented and rapid acceleration of liquidity tightening by the Bank of Japan. Unlike typical fluctuations, this persistent negative trend reflects a deliberate policy choice rather than a macroeconomic crisis. It signals a decisive end to the era of ultra-loose monetary policy and a major structural realignment in market liquidity. Looking at the multi-year trajectory, the speed of this transition is remarkable. In 2024, the monetary base was still expanding at a mild 1.0%. However, by 2025, it fell into negative territory at minus 4.9%. The contraction deepened into double digits in early 2026, reaching minus 12.4% in the second quarter, and culminating in the current minus 13.8%. In just 18 months, the pace of liquidity contraction has nearly tripled, demonstrating a highly aggressive policy shift. To understand this contraction, we must break down the monetary base itself, which stood at 554.9 trillion yen in July. Crucially, digital cash, held as central bank current accounts, makes up 78.4% of this base, totaling 435.3 trillion yen. In contrast, physical cash in circulation represents only about 21.5%, with banknotes at 115 trillion yen and coins at 4.58 trillion yen. This massive imbalance means that any shifts in total base are overwhelmingly driven by institutional reserves. This slide highlights a fascinating divergence between the physical cash economy and institutional digital reserves. While physical banknotes and coins saw only a mild decline of 1.9% and 1.1% respectively, institutional current account balances plummeted by 16.6% in July. This confirms that the contraction is not a consumer-driven liquidity crisis. Instead, it is an intentional, policy-driven drainage of institutional cash strategically executed through central bank operations. Here, we quantify the primary driver of this contraction. The stable behavior of physical currency means that banknotes and coins have a negligible impact on the overall decline. Instead, the severe 16.6% drop in institutional current accounts accounts for over 90% of the total monetary base contraction. By targeting commercial bank reserves rather than consumer cash, the Bank of Japan is managing to restrict institutional liquidity while maintaining stability in the real economy. Looking at the long-term trends, the total monetary base trajectory is virtually identical to that of current account balances. This correlation reveals an illusion of a broad macroeconomic slump. In reality, the underlying consumer-facing economy remains stable, with physical currency holding steady. The top-line decline is almost entirely a technical reflection of the BOJ's balance sheet reduction, designed to withdraw excess institutional liquidity without choking real-world commerce. While the year-over-year decline appears smooth, the month-to-month annualized rates reveal extreme operational turbulence. In 2026, we see sharp swings, notably hitting minus 22.8% in March and minus 22.9% in June, before recovering to minus 8.7% in July. This quarterly volatility points to intense balance sheet adjustments by financial institutions and uneven BOJ bond buying operations, meaning that the path of quantitative tightening is marked by sudden, short-term liquidity shocks. In conclusion, three pillars define the BOJ's 2026 posture: accelerated tightening with a 13.8% contraction, a targeted mechanism focusing on institutional current accounts, and a stable physical economy. This drainage will exert upward pressure on short-term interest rates and prompt banks to adopt a more conservative lending posture. Navigating this new phase of controlled contraction requires vigilance as we brace for further liquidity adjustments, particularly at the next quarter end. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.